Hi, I'm Grant Stephen.
And I'm Kris Bernier.
And we're the Two Investment Guys. This week, Kris and I are going to talk a little bit more about the markets. First, we'll just have a look at index returns from around the globe. We've got Toronto's up about 5%, the Dow's up about 6%, and the NASDAQ's up about 11% so far this year. When we look to Europe, we've got London up 6%, France is up about 11%, and Germany is up 17%. And we look at the Asian markets, we've got Hong Kong is up about 7, and Tokyo is up about 16, Kris. So pretty impressive returns so far. Wanted to say a couple of things. First of all, those that are begging for a pullback in this bull market here are not getting it. A 3% pullback versus an advance of 5 to 10% doesn't give a lot of these people that have been sitting on the sidelines the opportunity to step in. We wanted to talk about why that's happening and some of the fundamental changes that have occurred, albeit quite quietly, Kris, but things you and I have talked about.
Sure. Well, for most of last year and the latter part of the year before, the market was definitely focused on the headline news. Quietly, we've seen U.S. GDP accelerate. We've seen job growth. We've seen improvement in most economic data coming out of the U.S. And we now see the Dow sitting at about a 3.5-year high. You mentioned about Germany's returns year to date, up 36% since late last fall. Very nice rally off of lows, but nonetheless a very good rally from there. And that's indicative of what we're seeing in many markets around the world. Europe, sure, they're probably in recession right now, but likely to be a mild recession. And recently we saw Greek secure their next round of bailout funds. So we've been seeing a move away from a situation where correlations of various asset classes were very highly correlated, and now we're starting to see that fundamentals of companies come to the forefront again.
Yeah, that correlation argument, Kris, is really important because when the sentiment on the headline was always negative all the time on all things, everything was moving up and down in lock, stock, and barrel. Everything was moving together. Now what's happening is market participants are looking at this going, wait a minute, it's not that bad in some areas. And hence, that's the reason that we've had this bull market. Now, a couple of things, cash is trash, as they say. We're sitting here between U.S. government bonds and Canadian government bonds, at least the 10-year issue, around 2%. Gold probably isn't going anywhere. And the caveat I'd put on that is if the U.S. dollar strengthens, then that could change things a little bit there. Real estate, probably static. So we're back to equities, and this is something that Kris and I have talked about, is you have to maintain your exposure to equities because sooner or later things turn around, and in fact that's what's happened.
Absolutely. We'll just touch briefly on that, the interest rate and the bond story. We've seen a decline in bond yields. Roughly, that trend has continued for about 30 years. We are now touching on the lows again that we saw back in the fall and winter of 2008. So rates have very little room to move lower, so you want to talk to your advisor about your fixed income positions definitely, and make sure that they're still at appropriate levels, because you may have made some nice gains there, and you might want to look at rebalancing that component in your portfolio. As always, yield matters, get paid to wait for growth, focus on dividends, and look at company fundamentals once again. I want to thank you again for your questions and comments. Please keep them coming. If any of the topics we discussed today are of interest to you, please give Grant or I a call.
Join us next time. Kris and I are going to continue our discussion around the markets and maybe talk a little bit about the investor psychology aspect of all of this. So until then, I'm Grant.
And I'm Kris.
And we're the Two Investment Guys.